I imagine that most, if not all of my subscribers, classify themselves as savers. Many, I bet, have not really stopped to consider the key elements that differentiate savings from investing from speculating. The differences are subtle, but critically important. Understanding them will improve your chances of being successful in the savings endeavor. A long time ago, I put together a chart like this one to decide what types of assets I wanted to own for various purposes. I've updated it once in a while, and it now reflects what I consider to be the range of assets that I personally want to hold. After we discuss it, you might find it worthwhile to put together one of your own. I'm sure yours will look different from mine, but having one will help guide you in terms of your thinking on what you want to own. Let's go through this exercise together. Why do we save? For what purpose? Well, the cynical among us might say that we save just in case we don't die tomorrow. And that's a very true statement, but it doesn't shine a light upon the purposes to which savings might be put. In my mind, there are two very general reasons why we save. The first is so that we can deal with unexpected emergencies. Maybe at some point in the future, the car will break down and need to be fixed, or the furnace will crap out one chilly winter morning. Your son might break his arm during football practice, and since you haven't met your insurance deductible yet, you'll need to come up with cash. Maybe someday you'll lose your job and need a few months' worth of cash to cover living expenses until you land a new one. You don't really know the timing of these events. Some might happen this year, some might happen years from now. Regardless, you're going to need some savings to deal with these events. People who don't have sufficient savings when bad events happen are often faced with some very unfortunate choices. What makes for good assets to own as savings to deal with short-term and long-term emergencies? Well, they have to be items that are reasonably stable in value. In other words, you have to be able to count on them actually being worth what they're worth now when that unexpected emergency happens in the future. They need to not fluctuate in terms of purchasing power by a great deal. They also need to be very liquid. Liquidity means that there's a market for something and enough demand that the item that you owned can be readily sold for cash without having to wait too long or without having to settle for a much lower price than you'd like to receive. Why do we need to be able to convert things to cash? Well, simply speaking, cash is the coin of the realm. Regardless of how you feel about cash, it's what people currently accept for goods and services, and so that's what you'll need to come up with when the unexpected emergency happens. The types of assets that are good to have for emergencies, whether they happen now, next week, next year, or 10 years from now, tend to be very similar. Examples include savings accounts, Series I savings bonds, money market accounts, treasury bills. Sure, you won't get much of a return on them, but they will tend to keep up with the general trend in prices of goods and services, and they can be converted readily to cash, instantly, without significant loss. You need to make sure that you have enough of any one of these items, or more, to get you through the inevitable personal crisis. And it may come as a shock to some who have seen a few of my videos discussing currency reset that I own these things. But I do. I see them as necessary evils. Currency reset is a mathematical inevitability, but one that's very hard to assign a timeline to. It could happen tomorrow. It could happen decades from now. In the meantime, while you're waiting for your gold to be revalued multiples higher, you could have a personal crisis that requires you to have cash. When that happens, you'll want to have significant cash equivalents. But speaking of gold, I also believe that gold and silver can fill the role of crisis savings vehicles. Everyone should hold at least some gold and some silver, regardless of price, simply because in the event of a currency failure, the gold and silver will be what you want to be holding. But when purchased at good valuations, you can own a lot of gold and silver without taking on undue risk. I've talked at length about how to know when gold and silver are well priced. There are metrics that have worked well over time. Gold and silver, when purchased at good prices, can be a very good asset to hold long term because they have a very good track record of holding their purchasing power. Just not when they're bought during times when gold and silver buyers are in a speculative fervor. Another caveat that I'd like to add is that you have to be careful about the form of gold and silver that you own. We'll talk about this more in a few minutes, but low premium bullion coins tend to be very liquid and thus fit the bill very well. Another reason for saving is to realize certain spending goals that we have in the future. Because they are goals, they will be specific in terms of scope and timing. For example, you might have a goal to replace your car with a new one 5 years from today. You might need to save up to pay for a property tax bill or an insurance premium that you know is going to show up in your mailbox 6 months from now. You might want to have enough money saved up to send your son or daughter to college in 10 years without them taking on student loans. Maybe you're saving up for retirement, which you desire to start in 20 years. You get the picture. The key difference between savings that is used for goals versus savings for emergencies is that the timing and amount of the cash needed is known in advance when they're goals. For short-term goals, we'll still want to use the same liquid and stable vehicles that we chose for emergency savings. But for long-term goals, we can choose assets that provide us with a rate of return over and above the general rate of price increases. We might choose to hold bank CDs instead of keeping cash in a demand account. Thus, we will receive a higher rate of interest for the savings. For goals that are 20 years out or more, we might choose EE savings bonds, which are guaranteed to provide a 3.5% annual rate of return if held for 20 years instead of holding I-series savings bonds, which are currently yielding only 1.5%. Instead of keeping cash in a money market account, we might buy into a fixed annuity so that the insurance company will pay a higher rate of return while still guaranteeing to provide us the cash back at a specific time in the future. Instead of treasury bills, we might invest in treasury bonds. Be careful here though. It's important to buy something where the value in the future, when the cash is needed, is fairly certain. Individual treasury bonds have a maturity date at which time you're guaranteed to receive your principal back. There's a big difference between that and a bond fund which has no maturity date. If interest rates move higher as the date you need the cash approaches, you might find that you have much less cash available than you thought you would if you're holding a fund instead of an individual bond. And in the extreme case, where you buy an individual corporate bond or a municipal bond, you may find that the issuing entity defaults and you lose quite a bit of money. So you see, there are some assets that are very good to own for the purpose of saving, whether it be to weather the storm of personal emergencies or to meet specific purchasing goals. The key properties that make certain assets good for the purpose of savings are that they will be predictable, that their value is stable, and that they are very liquid. And just so that we're clear here, these assets here are the ones that I have decided are the most suitable for my goals. You may do this exercise and come up with different assets. I also want to make it clear that I hold paper financial instruments not because I particularly like them, but because I believe that they are necessary and because I have more than enough gold and silver holdings to be comfortable holding some financial instruments. So with that said, let's move on. I've talked in the past at length about using certain metrics to purchase gold and silver at the right times so that you can be reasonably comfortable that the value of your holdings will be stable and reasonably predictable. Let's talk about how you can ensure that your gold and silver holdings are liquid. It might seem like an odd thing to be concerned about, but bear with me. I think you'll find the discussion that follows to be useful to you. Let's talk about price discovery. It's a very important concept for the small investor/saver to understand. This concept applies to any marketable asset, whether it's stocks, bonds, commodities, or what have you. I'm going to use gold as the primary example just to illustrate some points. Let's start the discussion with a graphic that I used in one of my previous videos at the margin. It shows on the left all of the holders of the above ground gold stock, and on the right all of the holders of the existing M3 money supply. Some of the holders of gold on the left are interested in selling their gold in exchange for some currency. Some of the holders of currency are interested in obtaining some gold. But only some in each group are interested in making a trade at any point in time. In fact, we know that less than 100 million ounces of physical gold actually change hands each year, which is much, much less than the more than 5 billion ounces of above-ground gold. So what is it that sets the current price of gold? Obviously, since such a small percentage of the above-ground stock trades each year, it means that most holders of gold aren't offering it to the market, but rather just sitting on it as a wealth reserve. But there is a small group that offers gold to the market on a consistent basis. This is the group that sees all of the action, the group that makes the gold actually flow. It is this small group that sets the spot price of physical gold. The price they accept for their gold dictates the price that you, as a gold holder, can expect to get for your gold if you offer it for sale right this very moment. Let's look at the players in more detail. We have four main players. There is the big holder of gold in the upper left, who owns the majority of the more than 5 billion ounces of above-ground stock. They don't really offer gold to the market, and so they're not really setting the price. In the upper right, we have the small gold holder, who is basically a bystander in the market. They can hold gold and enjoy its benefits, much like the large holder of gold, primarily because 1 ounce of refined gold bullion is the same as any other. But the small holder does not dictate the price, even though he or she might care about the price a great deal. The speculator in the lower right does participate in the market and can move prices short term, but the speculator really only cares about price movement and deals in paper and not the physical. So the speculator does not dictate the physical price of gold. It's the miner in the lower left who has sufficient gold to offer to the market on a consistent basis. It is the miner who accepts bids from the currency holders continuously, and thus the miner who is the player who effectively sets the price of the metal at the margin. This is not to say that the paper pushers can't distort the market. They certainly do, and we'll talk about that in a moment. But the paper pushers will only move prices temporarily, and the prices will not diverge far from the price that's set by the miners, who are the suppliers of the actual physical gold. Remember, mining company CEOs are in the business of making paper profits. They are also in the business of keeping their company out of bankruptcy. So if the mines take on huge quantities of debt during the good years when there is high demand for gold, such as in, say, 2010, and demand subsequently trails off, then the mines will continue to offer gold to the market during the bad years, even at super low prices, just to secure the cash flow needed to pay for debt payments. Remember this, it doesn't make the price any less real to the small gold holder. The price is very, very real. It is what you can get for your gold right this very minute if you are forced to sell, regardless of how much you feel that your gold is worth. And this brings me to a key point. The price signals that you see are very useful to you. Yes, it's true that many holders of precious metals are holding because they think that it will fetch a much higher price in the future. There's nothing wrong with that. I personally think that gold will be much more highly priced at some point in the future also. But don't forget, regardless of what the price is many years from now, the price today and the price in the near-term future is also very important. Gold and silver are part of your liquid savings, which means that in the event that something unfortunate and unexpected happens, you may find that your gold and silver will have to be offered for sale, whether it is to pay the mortgage, or some medical bills, or some other expense. And that is one reason why you want to have sufficient cash equivalent assets to ride through these storms. But it's also the reason that it's important to know the current value of all of your metals holdings according to the market. Knowing the current market price of your metals portfolio will tell you what you can expect to receive in trade for your metal if you need to liquidate it to meet some kind of an expense need. Knowing the value will also help you get a fair deal in a transaction, whether you're on the buying end or the selling end. The nice thing about gold bullion and silver bullion is that it's actively traded in the market, and so there's a price available almost 24 hours a day. And whether you're in the market to buy or sell, you can be reasonably sure that you can make the transaction happen somewhere close to the currently listed price if you choose to participate. Of course, just as in other markets, there are some who can play tricks on you. In the gold market, for example, the speculators, who are mainly in the paper game, can do things during thinly traded hours, where there's little liquidity. They can create transactions which move the price to such an extent that stop losses get triggered. This causes computer trading signals to buy or sell automatically, which creates a price trend. Then the other computers, which are programmed to detect price trends, will amplify the move and cause the price to swing in the direction that the speculator desired to move the price. If you, the individual, are not careful, you might mistake one of these temporary price movements for the real thing and take part in the panicked action of all of the paper players. But I digress. The main thing to understand here is the mechanism of price discovery. Whether you own stocks, bonds, commodities, or gold, there will be an active market with an active price discovery mechanism. Knowing the market price is very important for you because it will give you an idea of what your savings are worth should you have to liquidate them immediately in order to meet expenses. And this brings us back to liquidity. In order to benefit from the price discovery mechanism offered by markets, you need to make sure that your assets are liquid. What is a liquid asset? Well, put simply, it's an asset that has a very active market where you will be able to quickly buy or sell an item close to a market quoted price. Let's take a look at examples of some assets and talk about the characteristics that make them liquid or not liquid. Let's start with a discussion of stocks. One of the most highly traded instruments on the stock exchange is the S&P 500 SPDRs ETF. It's the ETF that mimics the entire S&P 500 index. There's so much interest in this vehicle and so much activity that the bid and the ask price are very close together. They are within 1/100%. Commissions are the main expense an investor faces when buying and selling this fund. General Electric stock is not as liquid as the SPDR ETF, but it's still very heavily traded. So many people buy and sell it every day that the spread is a very narrow 0.08%. So, with both the SPDR ETF and GE stock, the small investor has the advantage of knowing that if he or she wanted to sell their holdings, they can do so very quickly and be reasonably sure of getting a fair price. In addition, at any point in time, the owner of the equities can look up what the market is willing to pay and use that to estimate the worth of their holdings if they needed to be liquidated in short order. This makes it much easier to plan. Contrast that to the next example, which is a little extreme. Suppose instead of holding GE stock or SPDR ETFs, the investor decided to hold call options for a small company called Customers Bank. The bid-ask spread for this instrument is about 35%, which means that if the investor bought the call option and then needed to sell it shortly thereafter, there would be an immediate haircut of 35%, even if the price of the underlying equity didn't change. In addition to this, the investor might find that he or she was in for a bit of a nail-biter because it might take days from the time when the sell order is given to when the order is actually filled, and when the cash is needed, this can be a very big inconvenience. Just like the market for U.S. equities, U.S. Treasuries are very, very liquid. Take a look at U.S. Treasury bills. The bid-ask spread on them is only 0.01%. Aside from commissions, the holder of a Treasury bill can obtain almost as much cash upon the sale of the bill as what was paid upon the purchase. Investment-grade bonds also tend to be fairly liquid. The spread on Ford Motor Company bonds is only 0.11%, and Ford is certainly not the company that enjoys the highest credit rating. So again, the holder of Ford Motor Company bonds, just as the holder of Treasury bills, can enjoy the advantages of good price discovery, namely, knowing at any point in time where he or she stands and the comfort of knowing that the asset can be sold at a fair price. Contrast this with a 2028 bond for a company called Global Marine. This is not the most extreme case of an illiquid bond, but we can see that it certainly does not have the active market that Ford Motor Company has. Real estate is an asset that many people own or aspire to own. Some forms are much less liquid than others. I certainly wouldn't consider a piece of rental real estate as liquid savings. For one, suppose you own a house worth $200,000. You certainly won't want to sell it to cover an unexpected car repair. Even for large expenses, the house won't sell quickly. Ordinarily, it will stay on the market for months, and even then, the National Association of Realtors estimates that the seller will have to come down in price by about 3%. This can be considered spread. In addition, the commissions are very punishing. Contrast this to a securitized form of real estate, the Vanguard Real Estate Investment Trust ETF, for example. This is an index which trades actively and only has a bid-ask spread of 0.33%. Plus, the commissions charged by a stock brokerage are much lower than those charged by a real estate agent. In addition, the ETF can be sold in much smaller amounts, while the house must be sold in its entirety or not at all. Clearly, the ETF is more liquid than the house. So let's turn our attention to gold and silver for a minute. Both gold and silver are very large markets that trade nearly round the clock. Bullion trades on the exchange have a spread of only 0.03% for gold and 0.13% for silver. Gold and silver bullion are very, very liquid. That's not to say that the price isn't volatile. Volatility and liquidity are two very different things. If you want to participate in this market and own physical gold or physical silver, the most cost-effective way to do so is via bullion coins. Gold eagles, for example, are very liquid. The difference between the bid and the offer on gold eagles is typically about 3%, which is not a punishing penalty to pay. One should be a little bit more careful with silver eagles. These items are less liquid, as is reflected by the much larger bid-ask spread of close to 10%. For both gold and silver eagles, it's best to hold them for a while. Trade them frequently, and your wealth will be whittled away. I put an entry here for illiquid bullion coins. I can't give you a specific bid-ask spread because they're very different for different coins, but let's take a look at an example so that you'll understand how the form of your precious metal impacts its liquidity. Here is a 2-ounce lunar mouse coin that's been on the market for a while. The seller, located in New Jersey, either thinks that it's worth $699 or thinks that he or she can get someone to buy it for that much. Maybe with a few videos on YouTube hyping this kind of coin, the seller will be successful in talking someone into parting with that much cash for 2 ounces of silver. Who knows? Anyway, the original listing for this coin was in January of this year. According to the listing, it actually sold for $699 with one bidder. This creates a record of sale on eBay so that others can see that the item sold for $699. Is this evidence that the coin is worth $699? Certainly there was somebody who was quote-unquote willing to pay that price. You'll have to decide for yourself after we talk about this some more over the next few minutes. Sure, someone could have actually bought the coin and taken delivery, but as you'll see, something must have happened that prevented the actual transaction from taking place. The very same seller who listed the very same item a week or so later for the $699 ask price got 0 bids on the item. So if the seller had it in mind that the item was worth $699, he or she has been having trouble convincing others that it's worth that much. Maybe more YouTube videos will be needed to make the case more compelling. Or maybe the seller just needs a few more friends to enter some phantom bids to get others interested. As you can see from the top of this slide, the seller is still trying to sell this very same coin. It's a buy it now item listed at $699. You can probably buy it if you like. It's been on the market for a couple of months now, so obviously the seller is having trouble fetching the price that he or she desires. Of course, Maybe it has something to do with the eBay sales that registered 3 months ago from Germany. The German seller, on the bottom here, successfully sold 3 of these items for $156.40 on a Buy It Now listing. An observant person in the market for a 2-ounce lunar mouse might see the 3 completed sales at the price of $156 and be a little hesitant to buy one for $699 only a few months later. That doesn't mean that it's wrong for the owner of the coin to try to sell it for $699. It's not illegal, it's not immoral, it's not even fattening to do so. But this person might be waiting for quite a long time. Which leads to the crux of the problem. Certain types of precious metal require quite a bit of work when it comes to price discovery. The less frequently they sell, the harder it is to know the fair market value of the item. It may take considerable time to sell these items, and sometimes the process of selling them could reveal to you the unpleasant truth that the market doesn't value them nearly as highly as you think that they should. This certainly creates a disadvantage to the person who holds them as savings assets. It's very difficult at any point in time to know just where you stand in terms of purchasing power, especially if you have a lot of them, because they're all different. Anyway, I hope you found this discussion of price discovery and liquidity to be helpful. Please leave your comments, and I encourage you to go back and make for yourself a chart like the one that I showed you at the beginning of this presentation. I think that doing so will help you to straighten out in your own mind what kind of assets are appropriate for you to include in your own personal savings strategy.